Hello and welcome everybody. I hope you're all well. This month we've changed the format of the call. Instead of doing it live, I am recording it, which means I can send you basically the details of the agenda, so that you can actually go to the parts that you might be interested on. I think it might be a bit more efficient. And if you have questions, please, you can actually send them through email instead of responding live. Without further ado, further delay, let's start. And I'm going to start by sharing the agenda. We're going to cover quite a bit of ground. There's a lot happening. First, a little bit of an overview of the situation of the framework. We're going to talk about the transition from a macro perspective from what is the reflation stage to what is increasingly more likely a stagflation with lower growth and higher inflation. We're going to talk related to this about the energy crisis that might be ahead of us and how this is debunking in a way the temporary inflation narrative from the central banks. This is potentially quite a big tail risk ahead of us, especially in the event of a cold winter. In addition, we're going to cover another huge topic that we've been discussing for a while, China and the real estate bubble that it's imploding in front of our eyes and the implications for the markets, and how central banks, and particularly the Fed, are trapped between this idea of creating employment, but trying to fight inflation and without really basically letting the bubbles they've created implode. So a very difficult, if not impossible, balance. We're going to talk about the volatility, which remains a key component of portfolio construction. And we're going to look in some detail at the relative value across the different pieces with respect to the vol surface, the skews, and this looks into the VIX or the S&P, gold, and some currencies. In addition, we're going to look at the inflation hedges. Over the last couple of months, there's been pretty much a massacre across many of these assets, and perhaps looking at the narrative and the conventional wisdom of if inflation is higher, interest rates need to go up. And why we disagree with this. In particular, also looking at the implications for gold and other hedges, including crypto. In terms of portfolio construction, we'll take a view at these two key dimensions. This is a review of the model using the sports analogy, where we need to balance volatility and inflation. And last but not least, we'll talk about obviously the portfolio, how it's performing. It's been and continues to be a very difficult environment for us. The current positioning, looking ahead, and the rebalancing we're doing. So without further ado, let's start with the framework. And I always like to basically present this is a team effort where you are the coach. As a coach, you need to decide the strategic allocation, how do you want to play this game, which players, both internal and external, you're going to use, and how you're going to rebalance, always with the objective of defending and attacking. And related to this, we've talked before about the risk of false diversification and how perhaps in this environment more than ever, what looks like a diversified portfolio during times of crisis may actually not be the case. And the flip side of that being, of course, a melt-up situation. So we're I think in a shift on the macro environment, perhaps from reflation to stagflation. And I think it's important to keep a big picture with respect to what's happening. And here I have to insist that it would be fantastic, but unfortunately, I believe it's a misconception that we could fix problems just by printing money and taking debt. The reality is we're not really solving these problems. The first thing we're doing is we're delaying these problems. We're kicking the can down the road through basically printing money, spending more, and borrowing more at the expense of future generations. The second thing that is happening that is crucially important is we're transferring the problems. We're not really fixing them. We are trying, first of all, to transfer the problem to our neighbor through currency wars, something that I think has been driving global macro for the last decade, as well as trade wars, which is in a way a defense mechanism against currency wars. If you devalue by 20%, I will tariff you by 20%. And this is at the core of some of the future potential imbalances. And we see how it's playing out also in the energy sector and China and many others. The third thing that's happened is we are transforming the problems. Obviously, by trying to print your way out of a problem, you're creating inflation. This is a tax on cash, is financial repression, but it's also creating a huge inequality problem, which can lead to populism, social tensions, and others. This is arguably a long-term problem, but it's very real and extraordinarily damaging. As a result, I think that by printing and borrowing your way out of the problem, you're actually enlarging these problems. And we are now facing bubbles that are too big to fail, systemic risk, and the risk of stagflation, which is the nightmare for any politician or economist, because you get the double whammy of higher inflation and lower growth. So in that sense, as a summary, I always say the last decade was the transformation of from risk-free interest to interest-free risk. I believe the next decade is and will be the transformation of bubbles too big to fail into stagflation, a process that is accelerating very fast. In that sense, and I borrowed this chart from Deutsche Bank. This actually shows very nicely how over the past year or so, year and a half, we've gone from what was effectively a recession, and this is plotting macro data surprises, the vertical on the horizontal axis versus inflation surprises, and we see how we've been dangerously moving from recession to recovery to the reflationary stage, and now what is more evident, stagflation, which I think it's potentially here to stay and might lead to more of the same. It's not an easy solution. As we'll see in a minute, you can't print oil, amongst other things. So moving on to the energy story, I wrote the book, The Flattening of the Energy World. The framework remains very much intact. In fact, it's been reinforced by time, but obviously things continue to change. And what we see now is basically a situation where energy is becoming a pretty meaningful problem. What is this? This is a problem that is global, is not isolated in a particular region. It's actually happening in Asia, in China in particular, in Europe, with a lot of tensions with Russia and also the USA. But it's a global problem. It's also a problem that is taking place across the entire energy sector. It's actually natural gas and the electricity sector that are leading the way, following a very cold winter last year. But crude oil is lagging, and there are interrelationships between these commodities, including energy substitution, which are effectively pushing crude oil higher, currently around $80, but with the risk of 100, 120 being quite real, quite possibilities. This comes particularly because at the end of the day, you can't print commodities. Last winter was very cold. Here in Spain, we had a snowstorm that we hadn't seen in over a century, Filomena, and we were trapped pretty much for a month, something unprecedented for Spain, for Madrid, for the entire country. And there's actually a risk and indication that we might have another very cold winter, which given the situation with the inventories would be very, very difficult. In fact, the inventories are not sufficient, and therefore in commodities, it's going to be a function of higher prices that are going to destroy demand and substitute demand and incentivize supply. But in the short term, those inventories, which are the cushion, are unlikely to be able to give us all the demand at current prices. So something will happen, and watch out for a cold winter, because that could tip the balance. Behind the supply problems, we see the ESG basically narrative. The ESG green initiative means that fossil fuels have had a bad name. So the last few years, the returns have been poor, and that has not attracted a lot of investment. Just a year and a half ago, we're sitting on negative crude oil prices. So how much worse can that be? And looking into the next decade, everything has been about green energy. Therefore, there's a severe problem which is not going to be easy to fix in the short term. And we have some key meetings into next month in Glasgow. And I think this mini energy crisis we're witnessing right now will obviously put into question some of those plans and focus more on energy security and diversification of the pool. The other thing that's happened, obviously, is demand. The recovery with the vaccines, etc., has been actually pretty strong. We still haven't really fully opened the airline space yet. The land transportation has been pretty strong. It led the recovery throughout the first half of the year. People were more keen to go into their individual cars rather than mass transport. But now we're looking into potentially key economies like the US opening up to air traffic, and that could lead to incremental demand, which will need to be satisfied with physical barrels we cannot print. The issue with commodities is, particularly energy, is highly inelastic. There are multiple ways to think about this. It's not a constant number, but you could think roughly that at the current prices, in order to create room for incremental 1%, we might need to see prices about 20% higher. This is how inelastic things are. People are more likely to pay 20% more than stop driving or taking the bus. And what we're seeing as well to compound things is energy hoarding. So China has been on a mission to secure their energy and pretty much at any cost. They've been accumulating LNG, liquefied natural gas, and this is part of the reason why things are quite tight on a global basis. So the situation is dire. It's very fragile to climate. We need to watch out for a cold winter. And I think the key message here is, yes, you can print as many dollars as you want. And in fact, that's created a lot of demand for physical stuff, but you can't print oil or any other commodity for that matter. So in that sense, the supply-demand imbalances, given the current setup, the risks are very skewed for higher. We see, and these are a couple of graphs borrowed from my good friends at Bank of America, how huge the moves have been. Here you see the entire complex. You see LNG. You see European prices for gas, for electricity. And whilst crude oil is lagging, perhaps crude oil is the one that people pay most attention to, but the rally has been driven by other sectors. This is just, we're talking about 100, 200, 500, 1,000% increases depending on the commodity and the place. This is obviously huge, and it's putting a lot of pressure on the consumer, and also in many cases governments that are going to be subsidizing this. We'll talk about China later, and how the fragile China situation is actually potentially being more compounded by a very difficult energy setup. The question is, how high could energy prices go? And this is a great framework, again, from my good friend Francisco Blanch from Merrill, my former colleague. And we went through this in the past. And the idea here is that any given sector has certain limits, upper limits and lower limits, before it actually goes bust or makes the other sectors go bust. And you see that in the 70s and 80s, and then again in 07, 08, it was these very, very high energy prices, which contributed to, they reached, call it 7, 8, 9% as a percentage of GDP. So out of your $100 of activity, how much was actually, or your pocket money, how much in some ways was going to energy as a proxy. And you see that the current prices are, even if the nominal prices of commodities are higher, you see that the amount of money being printed, it's been ginormous. And as a result, the room for energy prices to go up before we get to a similar level of tension, of tightness, is meaningful. So the potential room for price appreciation is significant based on these parameters. So, at the end of the day, the more dollars you print, if you have the same amount of barrels, then something has to give, and that something is prices. So this is how the monetary printing fits into the equation, which is something that the naked eye will not see, but it's effectively the monetary tide is rising, and this inflationary pressure is coming, and it's obviously having an impact in commodities. Let's move on to the next key topic, which is China. I've held the view for a very long time that China is a big problem, is a huge bubble around credit and real estate, and we're starting to see with Evergrande a situation that is, in my opinion, extraordinarily difficult, but it's nothing new. I mean, the Chinese government has been following a policy, as we all know, driven by central planning and control. This is a bit of a double-edged sword. You can think about the one-child policy and what that meant. Of course, in the short term, you have more resources, etc. It creates a problem with demographics and the pyramid, which is down the road. You can then actually control your exchange rate and impose pegs, but there are things that happen. We're going to have some sort of pressure building through rate differentials, inflation, misallocation, black market, etc. You can also plan growth, to the second decimal point, and this year we're going to grow at 8.88, the lucky number, and you're going to achieve that, because if those targets are not achieved, then things happen. So this creates misallocation. You might do a roundabout you didn't need to do, and obviously you have all this setup where monetary policy and credit are mixed, where the central bank lends to the banks, and the banks transmit that immediately through all these projects, and then multiple other ways of unregulated credit, which effectively are a double-edged sword. You have the illusion of control. It gives the perception of being this giant that has everything in control, but it's a lot more fragile in my opinion. And I use the example of a skyscraper. You could think of the most resistant skyscrapers in Tokyo are almost like rubber. If you had skyscrapers made out of concrete, they would fall with very, very small things. So that perception of rigidity could, under certain circumstances, be a fragility, and I think that's the case in China. But there are many more things happening. Again, this is a multi-year project. The opinion here is very contrasted. You have extraordinarily smart people arguing the exact opposite view. I just want to lay my case. But I think China, beyond the central planning, has a bunch of kind of wars being played. We have trade wars with subsidies, dumping, tariffs, a model that has relied on for a long time on exports, and has tried to change that model, but it's wishful thinking. You perhaps introduce that idea, and then every crisis that comes, you resort to the same measures. We have currency wars, with currency controls, and there are lots of things that give in the system. We have China trying to position itself for the reserve currency versus the US dollar, which kind of explains in some way the incredible stability of the currency that is oblivious of anything that is happening. It's almost too stable, I would argue, and it's 100%, I think, managed. And this is something that could give in a big way. Geopolitics, thanks God, there's still not real wars, but we've seen what happened in Hong Kong. We've seen increasing tensions in Taiwan and a lot of provocations. We see the war on technology, obviously a big enemy to the Chinese central government, because you want to control people in this big brother. So effectively a bit of the development of technology in the case of China has created further control rather than freedom. And we've seen many things like Bitcoin being prohibited lately in an economy where, again, its technology is something that the government really wants to control, and it has gone for the Alibabas and other companies which have throughout the year had a massive sell-off. We see culturally, I think this is very important, the Xi moving for modern socialism, and it's kind of a war on billionaires. And I take a very simplistic view. Is culturally, if you're a child, you know, which superhero do you want to be? Do you want to be Superman or Jack Ma or Xi? And I think President Xi has this ambition of the model, and he's literally crashing this idea of capitalism. Is served well for a while, but it's actually doing it in a way that you know, it's hard to justify given the damage that the companies are taking. But it's part of the plan, it's part of the control, and part of the mission here, the cultural mission. So really quite a phenomenal setup. The Cold War arguably is here, the war over the internet, etc. And basically some of these rigidities of the system, in my opinion, something gives in. So if you have a setup where you're controlling the currency and there's a crisis, and you print effectively your way out of this problem by lending more money, etc. That money that is being lent is being printed. You create this effectively pool of money, this liquidity that cannot exit. And of course, like water is going to flow. And it's going to flow into things like infrastructure, into real estate. And this is the reason why China has this ginormous bubble, where it's a matter of time that it exploded, simply because, you know, you take the prices to a level where people can just not afford them. And I think the danger here is, you know, again, we've had this ambition to create this growth through infrastructure and others. And we're talking about a part of the economy is 30% of the Chinese GDP. So, you know, a crisis in real estate in China has phenomenal implications for many things, but it's really the result of these degrees of rigidity, where the degree of freedom has been effectively the creation of inflation and bubbles. And as we'll see in a minute, in my opinion, the ultimate degree of freedom is a much weaker yuan, which is the currency, which is one of our base cases, something that has not materialized. It has hurt our performance, but we think that insurance could potentially be very valuable, and it's a tail risk to consider. Basically, China, when in trouble, print, lend, subsidize, warranty people, bail out. And this is a very complex setup of seemingly very controlled things, but all much more fragile, in my opinion. What we see in these graphs is this relationship, you know, how between US equities and Chinese equities. And we see this major divergence. Obviously, the crisis tend to impact both. And to some extent, we've seen a decoupling, particularly since throughout 2021, where, you know, US equities have continued relentlessly higher, whilst Chinese equities have been suffering significantly. Since the period here at the beginning of 2018, we can see that on the graph at the top, how US equities, the S&P is up 63%, whereas the Chinese equities are down over 22%. So very dramatic divergence between them with a massive outperformance. Part of this is related to technology. Here, the differences are even more extreme, and particularly through this year when Xi decided to attack and go against the IPO of Ant, and Jack Ma disappeared, and this battle for technology and this cultural change. This is something that, again, has resulted in pretty meaningful divergence, but I think it would be unrealistic to think that this decoupling can last forever. And we're starting to see a little bit of a sell-off and pressure in the US. But I think the important thing here is how perhaps the wealth of the US is much more equity focused. The wealth of the Chinese is much more real estate. Either way, you can let the equity suffer in China. It won't help, but China has their plans. So quite a dangerous game, massive divergence. And here we see, this is something that I emphasize a lot. China can actually print as many yuan as they want. They cannot print US dollars. They cannot print commodities. And in that sense, related to, this is kind of the end game, but perhaps the catalyst, as we see on the left, is, I think we're seeing Evergrande is taking the news. What we see is perhaps, in my opinion, the tip of the iceberg of a ginormous problem. I use the example or the parallel between the GFC, and I think this is Lehman Squared. If it was a movie, it wouldn't be Lehman 2. It would be, yes, it would be the sequel, but it's not twice. It's exponentially higher. And in that sense, we have the potential for one of the largest bankruptcies ever in history. As it stands, I think it would be number 3 behind Lehman and Washington Mutual. But there are, I think it's still early days. It could well be the largest. As we'll see in a minute, there's plenty of other people to follow. Earlier this week, we saw Fantasia, a small player that is not even in the radar, with a meaningful, without not able to meet certain payments. And we see again how the importance of the real estate sector is so critical that I think the government will be forced to intervene. But for the time being, they are actually letting some of these players go down, or at least intervention hasn't taken place in a proactive manner. Part of it could be also getting, some of these billionaires are they're crushing these billionaires, and they may want to buy the assets for nothing. But certainly the problem with real estate and the impact on the wealth for the Chinese is huge. The key thing, in my opinion, is the contagion risk. Beyond this huge potential default, is what does it mean for other players, for the banks, and also even all these wealth management products. A lot of people's savings have been put into these companies, and therefore, I think the Chinese government will do whatever it takes to protect the individual, and it might create a bit of basis between the onshore and the offshore market. We'll see how people are treated, but clearly China will benefit the onshore market. All this slowdown and deleveraging will invariably impact global growth. This has implications beyond China. That's why I think the decoupling story is unrealistic, but it's always a phase that we go through. And as I was pointing out earlier, I think the end game in China is a massive devaluation. They will, I don't think it's a matter of when, it's a matter of how much and when. It's not a matter of if, it's a matter of when and how much. And so in that sense, fighting or looking for this potential devaluation has been very, very expensive, very difficult. The yuan as of today is a positive carry trade. The 10-year Chinese government bond is about it's paying about 3%, and that's attracted a huge amount of capital from investors looking for the double benefit of yuan appreciating and earning some nice carry. And I think one of the key things that could tip the balance here on a current and capital account basis would be energy. So I think higher energy prices could easily tilt the Chinese balance, and we're talking about an extremely fragile situation from a real estate perspective and infrastructure and etc., with lots of complex credit guarantees, which might require printing. But if on top of that you add the energy crisis, it's kind of game over for the yuan. I think China, with this could be a catalyst that could accelerate things. So ultimately, my view for China is quite negative. The model is the idea is good, the implementation is always the same, and they resort to printing and guaranteeing people. You could pretend and say that they're not doing QE and that the debt of the government is small. However, is all sitting in hidden parts and state of own enterprises, and basically a whole entangle of things that are guaranteed. So China, a very big problem, and we think that the devaluation of the yuan is probably unavoidable. But there are certain potential catalysts that could accelerate the process. But again, fighting this has been extremely expensive due to the negative carry, and extremely difficult due to strategic considerations such as China positioning for reserve currency and attracting it, trying to give this sense of stability that has attracted and in my opinion, maybe trapped a lot of investors. So time will tell. Watch out for volatility, because if volatility picks up aggressively, some of these carry trades might need to be unwound, and that would be another consideration. So this is some numbers put on by my team. Is just a bunch of developers, and we rank them based on the performance over the last year from worst to best, except one. Every single entity was down on the year in a meaningful way. You see that Fantasia, which missed almost, a meaningful payment earlier this week, is not even in this list because its market cap is so tiny. But we're talking about a problem that is really across the board, and we select a number of triggers and monitor or basically parameters or ratios to monitor, such as debt to EBITDA, cash ratios, or total debt to total equity, all of which are beyond the red flag. So this is by no means over, and I think it's a huge problem. It's a Lehman Squared problem. We'll see how China and the rest of the world deal with it. My view is devaluation of the yuan alongside a lot of volatility. Let's move on to the next part, which is basically the central bank trap. And I think here what we're seeing is strong evidence. Central banks have been for the longest time trying to solve the problem by just printing money, print your way out of the problem. We've seen zero interest rates, QE, yield curve control, negative nominal rates, then with higher inflation, very deep real interest rates. They've expanded the printing to buy not only government bonds, but also credit and equities, as has been the case in Japan or Switzerland. Money being printed and literally being handed over to people through helicopter money and MT, and basically all sorts of issues that eventually, as Voltaire would say, if you abuse monetary policy, if you paper currencies will eventually converge to their intrinsic value, and this is a core part of our thesis. And I think the game is built in a way that if you give the government the printing press, they will use it, particularly during crisis. And this relentless approach to basically avoid short-term pain is creating a much bigger long-term pain. So as you all know, my view is, this is a misconception. You cannot print your way out of a problem. You're really, as we said at the beginning, delaying, transferring, transforming, and enlarging the problem. Now, I think to put things in perspective, I've gone through this in previous calls, but it's really a very interesting long-term perspective with respect to, in blue, this is the last 23 years of monetary policy. And once upon a time, in blue, you see Fed funds, short-term interest rates in US dollar. In white, you see the size of the balance sheet of the central bank, and how, once upon a time, the 2001 crisis was managed purely through interest rates. We took things to 1%. The recovery with the revenge of the old economy in China and others, and was very strong. And we were able to go back up to about 5.5%, but eventually things blew up, and as we all know, and it took us to not only zero interest rates, but a significant jump in at the time considered to be huge. Look at the perspective today with quantitative easing, which was considered to be unconventional and temporary, words that are perhaps familiar. Temporary things in central bank land tend to become permanent, and unconventional tends to become conventional. Today, even South Africa will do QE and not even bother do it at zero rate. So the central bank printing, it's become huge. We saw QE2, QE3, QE infinity, which coincided with the European crisis. But it's notable that interest rates remained very low for a very long time. And by the time we tapered, and then a couple of years later we started hiking, and things were tightening. Eventually, the interesting thing for me is that interest rates were at 2.5%, and the world blew up in Q4 2018. Effectively, as we'll discuss in a minute, our ability to increase interest rates decreases with the amount of debt outstanding, and these two processes of printing and debt go hand in hand. So Q4 2018, brought us down to 1.5%, and this is pre-COVID, and obviously COVID has been a game changer, both in terms of bringing rates to zero, but the dramatic increase in money printing and QE, which is given the name of MMT, whereby theoretically the new miracle is that you can actually spend and borrow without even having to increase taxes. So this dynamic, if we add one dimension, which is what's happened to long-term rates, long-term rates in some way could be viewed as some sort of expectation of where short-term rates will eventually settle. And you see how it actually worked very well as a predictor for how high rates could go. And this is why the inversion of the curve sometimes is a bit of a red flag. But we saw already how in 2018, the market was, perhaps more optimistic. The view was we will be able to hike more, and big banks were calling for several other hikes, and Jerome Powell himself was on autopilot until the wake-up call of people started blowing up left, right, and center, made them realize that all this monetary and fiscal abuse had a price, and that means you can't really normalize things. And so we're now in a situation where obviously how long will it be at zero? The taper with inflationary pressures is almost unavoidable, but now we're seeing these dramatic issues, in my opinion, in China and other risks that if they materialize, they could delay it, but also how long will we be at these levels? And also from a ceiling perspective, I think the market is trying to figure out, to what extent can we hike, and how do we respond to inflation? And this is part of the volatility and confusion of the new paradigm. In my opinion, we will see lower rates for longer, and I think the US is following the path of Europe and Japan, and will eventually have high inflation and low interest rates, which is, again, something that is out of consensus. In that sense, we saw last month how the Fed, in terms of expectations, has this view that, we will taper, we'll start hiking. This hawkish surprise to the market actually, as we'll discuss later, had a very big impact in certain inflationary hedges and other areas such as gold, which continues to be battered. And here the interesting thing is also the terminal rate, how high the Fed thinks we could raise interest rates in the long term. 2.5% is science fiction, in my opinion. We saw that in the previous graph, how 2.5% was things already blew up with the debt levels pre-COVID. So I think that long end is unrealistic, and the market kind of agrees, as we'll see and as we've seen. So the Fed has this view that the things are going to be okay and we'll be able to normalize. But this is something that they tell us, and however, as we see in this graph, the terminal rate has continuously been reduced through time, and I think it will continue to do that. So the second pillar beyond printing your way out of the problem is borrowing your way out of the problem. And here again, government spending and sustainable levels of debt, the inability to hike interest rates. In fact, try to overheat the economy and a la Trump, perhaps cutting taxes at a time when they were not particularly needed has created a lot of imbalances, which bring us on to many issues. Bailouts. Do we let people be fired and pay them the unemployment, or do we subsidize the company so that they keep those jobs? One way or the other, but strategic industries, etc. Money printing always behind this, and MMT we discussed, trade wars. So overall, I think this problem of printing and borrowing go hand in hand, and eventually relay also on this big debate of inflation versus deflation. There's, in my opinion, no question that the end game is inflation. That's by construction. I've talked at length about many of these topics, such as how the 2% is sort of the frog in the boiling water, how central banks have lost their independence, which it was paramount at the beginning in the process of setting fiat currencies. Now it's not even questioned. I mean, everybody knows that the central bank is obviously acting in by instructions and of the central government, financing their debt, etc. And whilst there are many deflationary forces such as technology or demographics or unemployment, we see this insane amount of money printing, which alongside other issues such as the energy stories, increasing inflation expectations, and I think will contribute to, as I said, these bubbles that are by now too big to fail, etc. So inflation is not so much about the value of your house going up because of demand, more of the reflation story. Inflation is really partially also about the value of your money going down, and this is a new paradigm. Everybody, I think, by now should be aware of the new paradigm, the change of rules, and to see this in perspective, I've used this before as well. You see 10-year nominal rates in orange, and you see if you adjust by inflation, and this is official inflation, which is obviously you don't need to be a genius to realize that it's a joke, and that the official inflation is substantially below the real inflation that most of us are experiencing. But nevertheless, even with these levels, you see that basically we used to live in a world where basically the return of money was positive. You could actually lend money to the treasury, earn your 5-6%. Inflation was 2%, and you could actually earn some real return from keeping your money in fixed income. However, already in the US, with the European crisis, we saw that risk-free interest in real terms no longer existed. We went into negative nominal real returns, and we've been flirting over the last few years with pretty close to zero, but I think COVID has actually dramatically sent us into a world of negative real yields. And this is given the impossibility of raising nominal rates because bubbles would explode, and the increasing pressure on inflation. I think we are likely to experience a world of very negative real returns. This is, as I say often, if this was a video game, it would have 3 levels. The first one is, can you make money in nominal terms? Can you make your $100 be more than 100? The second level is, can you make money in real terms? So you might be making $1 in 30 years, but can you beat inflation? And that's already an incredibly difficult game, at least without taking a substantial amount of risk. And third is, can you make money also after taxes, which is coming left, right, and center. So we'll see where it takes us. I am my view, and it's been reaffirmed and confirmed. Not everything is exactly fitting. Things like gold, as we'll see later, for me, seem to be out of whack with everything that we're seeing. But nevertheless, going back to inflation, we see that inflation break-evens, the expectations are increasing. Here you see they're across the board, and we're in many cases at levels that are breaking out of historical, above historical standards, even post QE, where inflation was thought to be a huge problem. And you can see also those pockets of deflation in the system. So this is, in my opinion, one of the most important slides, because basically we need to understand that the entire construct today is artificial. We have a world of artificial low interest rates, and when there's no such thing as risk-free interest, and basically it has very deep implications. The 60-40 balance portfolio doesn't work anymore. Once upon a time, your 10-year bond or treasury paid you 5%. And if there was a crisis and yields went to zero, they would make you 50% capital gains. And in the case of Europe, we're already negative nominal yields in many of these bonds, so in the Bund. So basically the ability for the Bund to defend is very limited. And therefore you have a scenario where your equities are artificially high, your bonds are artificially high, and you lost that defending power of fixed income. So we need to find alternative ways to defend. The problem, and the very simple explanation of why artificial low interest rates lead to artificial valuations is, if you think about valuations as the present value of expected cash flows, well, once upon a time with interest rates of 5%, the present value of $100 was 8.7. With interest rates at zero, present value of $100 is $100. So anything that has any remote expectation of making money, even in the very distant future, will be very valued today, and that explains the huge PEs and the duration of equities. Now, this is, I insist, artificial and by now too big to fail. The wealth effect and what these huge valuations mean, or what would happen if they were to unfold, is certainly systemic, and it's everywhere. And that is the reason why I think monetary policies, the normalization of monetary policy, is science fiction, and all the taper and hike talk will eventually be challenged and be a lot slower, a lot lower, and we'll see if and how far we go. But I think inflation will give in unless we have this big burst in the bubbles, which would obviously be deflationary. So the inflation-deflation debate is not obvious because it's not a straight line, it's much more of a circle. You can create huge amount of inflation, and once those bubbles burst, you could actually end up in a worse position where you started. So not a very fun setup. This graph shows the point I made earlier with respect to duration on the equities. And this is important because if you want to compare apples with apples, you should basically look at the implicit duration in equities and compare it to the right fixed income. And this shows you that equities have not only been expensive through risk premia they're expensive both in absolute terms, but also in relative terms when you take into consideration the effective duration of the S&P, which we think is about 28, 30 years, or the NASDAQ, which is above 40, in our opinion. If you want to look into this in more detail, my colleague Alfonso Torres wrote a great article which he published in LinkedIn called "No Premia in Risk Premia." Moving on, looking at equities, it's been an extraordinarily one-sided market at the top of the Bollinger for the entire pretty much year. We're starting to see a little bit of pressure. Perhaps the market is going from more of a buy the dip to sell the rally. The last week has been very volatile. We're starting to see big swings. Arguably, the momentum the markets were a bit oversold, which explains some of the recent price action. But the outlook is, in our opinion, negative, and I think these markets have significant downside in absolute terms, and we're positioned for that. We'll see how it plays out. Again, it's been very difficult and very expensive to buy insurance against these corrections, and bubbles always go longer and higher than anybody expects, but they also go lower and faster than anybody could anticipate. So watch out with all these tails that we discussed, like China and energy and others, as potentially and growth and inflation as things that could trigger some of this complacency, and we'll see. Related to this, one of the triggers that I insist a lot is volatility. I always use the analogy of comparing with fluid mechanics, and we see that there's a relationship, a bubble anti-bubble relationship, and I think that a breakout in volatility creates this mechanical process whereby effectively high realized and implied volatility can result in forced liquidation, deleveraging, liquidity thinning up, correlations polarizing, value at risk increasing, and more liquidation, which effectively creates a mechanical process of destruction. This is what explains this kind of bubble anti-bubble relationship, and how every single meaningful crisis has led to big spikes in volatility. But the mirror image is also the melt up. If you have volatility being artificially low through complacency and quantitative drivers, then you could actually see investors being sucked into the rally, such as trend followers, risk parity, or vol targeting. So in that sense, we see a little bit of a sell-off in equities in the last few days, accompanied by a bit of a rise in volatility, but not as high as some of us would have thought. The market is still very calm, and the VIX, perhaps a lot of people have already bought the insurance. I wouldn't blame them, because there's really I think good value in that insurance, and there are too many red flags. But nevertheless, it has been a very difficult game to be buying insurance in this environment, and we'll see how we cope. But to make things more difficult and worse, one of the key defenders or goalkeepers of the portfolio, which is the VIX, as many of you know from previous discussions, there's a big difference between the index that you see in the newspaper or your phone, and what you get from investing in the VIX and rolling that front month position. And that difference is so large that is staggering. This is since we launched Igneo 3.5 years ago. The VIX is up about 61%, but an investment in the VIX ETF would have lost 80%. So really quite phenomenal. And this is explained, some of these, big volatility moves and how they realize on time, but it's mainly through the risk premia in the curve. You have you can see here in periods of crisis, these big moves in volatility are considered to be short term. Volatility is more mean reverting. And then the big losses incurred encourage people to perhaps buy this insurance and pay a premium, which is the form of contango. And this has resulted on negative carry of over 10% per month, which is huge. And we see how in the last few months, the curve is flattened a bit, still far from perhaps a flat curve or backwardation, which sometimes is sort of the flag for bigger things happening. And you see how the back end has been, currently around 25. I'm talking about the expectation for the VIX in the medium term, whereas the front is much lower. So negative carry, a huge problem. If you try to play through options, the implied vol and the skew is phenomenal. So this means the premium for higher strikes, the distribution is not log normal. The market gives a high probability of big moves in the top side, very, very asymmetric. And you see in this curve how $60 calls trade with over 100 volatilities of premium, which is really just quite extraordinary. So if the event happens, which could happen, then you're already paying a significant premium for that. So it's quite challenging really to be able to hedge this. And what we've been done historically is we've been buying call spreads, which basically try to monetize this skew that, whilst justified, it just makes the trade extraordinarily expensive. So regardless of what you do in a market where the VIX stays low and carries negatively, then there hasn't been any joy in buying this stuff. But again, it's like many insurance, perhaps it can be cheapest when you need it the most. Having said that, timing is very important, very difficult, and particularly in this market. So a lot of what we do is try to identify this relative value, as we'll see. And this relative value really touches on many forms of carry and potential defensiveness through interest rates and carry on a forward basis. Also looking at the skew and levels of volatility. This is the volatility surface for gold, which is moderately priced, very steep contango in terms of term structure. So volatility is more expensive for longer periods of time. They're more natural sellers of insurance in the short dates and more natural buyers in the long dates. And then a very marked smile, as you can see on the right-hand side, where there's a premium for both a big move up and big move down. This is perhaps a more normal way to think about this. I picked as an example the yuan as to see what the market is pricing. And here we see also a clear, on the section on the left, you see the term structures in contango, which makes sense. So again, more natural sellers of volatility in the short dates and a premium for longer dates, but also a marked call skew. So the market remains much more concerned about the potential devaluation of the yuan than the other way around. So these are things that we need to factor in when we decide what insurance to buy. But I think it's interesting also to see the massive divergence from a dollar perspective between the yuan, which has been appreciating significantly throughout the last year, despite all the troubles. We're still dramatically dramatically higher and stronger, whereas things like gold have suffered a lot. So we see an opportunity here, and we have insurance that is looking for higher gold and lower yuan. Again, this potentially is a very good entry point. We'll see in due course how things play out, but we do see and have a view of that the yuan could be lower and gold higher. To complement the China story, but as well with geopolitics and carry, I've highlighted, and we have a meaningful position in the Taiwan dollar. This is effectively very highly correlated, as we saw before, with the Chinese yuan, but it's actually dramatically different in terms of forward structure. So a lot of natural people that were buying and hedging products in Taiwan wanted to lock in, the sellers wanted to lock in those benefits, and that opens an opportunity for risk premium. So in the event of a geopolitical event, we think volatility could go up, the forwards could tighten, and this could be a very good hedge. Once again, the last year is gone completely in the opposite direction. And so many of these insurance are now marked almost at zero in the books, but I insist they're alive. They'll be alive for a while, and we think they're valuable, good decision, maybe bad outcome, but we'll see how the movie ends. I will touch on briefly on this move on taper, and inflation has been basically a massacre for many of the assets, gold in particular, which has been suffering tremendously over the last 15 months since all-time highs, despite having quite, in my opinion, a strong fundamental story. Many of the things we discussed with respect to inflation and monetary policy and debt and bubbles are supportive, yet the market's been in a mode that it's been much more focused on perhaps a more benign perspective. Lots of people ask why is gold doing so poorly, and there are multiple reasons, but perhaps it's this perspective and this perception that you can actually solve problems, that inflation is not really coming, that the problem is deflation or is temporary. The actual outflows or even crypto, as we'll see in a minute, many of these things have created a lot of capitulation in the sector, a lot of pressure both on gold and miners, and we continue to believe that gold has a role to play, and that these are great levels to accumulate over the medium long term. My view remains that we might see $3,000 to $5,000 in the next 3 to 5 years. Time will tell. In that sense, touching on crypto, it's been quite extraordinary price action. I am very impressed by how well it coped with the outright prohibition from China. That making it illegal was a big challenge for both the miners as well as the people that are trying to get the money out. But it's been really extraordinary, and to be honest, it's been very impressive how well it's done. I still believe that many of the arguments are fallacies, and I still think the sector, the crypto, is more bubble than anti-bubble, but the price action is undeniable, and I think some of the risks and dynamics that I presented in my article in LinkedIn are playing out, and I recommend people to read and make an educated discussion. But quite a fascinating part of the markets, and invariably and undoubtedly, a lot of people see gold as kind of dinosaurs money, and Bitcoin and NFTs and all many other things that I consider to be much more in the bubble territory, and fallacies are for the time being performing really strongly. So we don't have a position, we don't either way, long or short, but I think it's worth highlighting and at least having an educated view on what's happening. I'm gonna just move on into some of the more strategy specific things. Before I do this, I think it's important to understand that from a big picture perspective, when we build a team, people should not only look at the striker, midfielder, defender, risk on, risk off, but also look at inflation as one of the key considerations. And in that sense, I believe that cash, credit, and fixed income, which are short inflation, are going to are going to pay for this party. The $100 that you have in your pocket or that your Telefonica or bond will pay you back in 30 years, those €100 are really not going to buy anything at all. That's my view. So in that sense, I think people need to construct portfolios that are positioned for both risk on, risk off events and volatility, but they do it in assets that are more long inflation. That's why for a long time I've been favoring equities, real assets, and anti-bubbles, including gold and volatility for the portfolio construction. With that in mind, Igneo has continued to suffer. It's been very, very difficult past 15 months. Basically, the drivers have been lower gold and our insurance against equities lower, China lower, gold higher, inflation higher, dollar higher, VIX, etc. haven't really played, but we remain focused on our mandate, and we think that from a factor perspective, many teams, many portfolios are very one-sided into risk, and I think this might be a great opportunity to add defenders that do well. We discussed the challenges of the VIX and the opportunities in cross asset volatility, etc. It's not easy, but yeah, I think it's important to understand the behavior of the pieces and construct teams where the players will do their job and ultimately build a team that wins. Here we see how a simple portfolio with 50% in S&P, 50% in Igneo would have done quite well. The negative correlation is very evident where, when equities do very well, we've done worse and vice versa. And I think here it's important to see also this hostile market argument. We haven't had a proper hostile market in a while, but we believe that we're well positioned to repeat and do very well if and when needed. In the meantime, this basket would have generated high returns with low volatility. It's really about the team play, and if you introduce compounding, even if the last few months you arguably would have been better off just letting the equities run, the compounding is a net positive contributor to the strategy. By compounding, what I mean is you have your targets, your strikers, your goalkeepers, and as the markets move, you basically take profits, sell high, sell expensive, buy cheap, and buy cheap, sell expensive to try to compound on those returns. The leverage version, Aqua, which is approved but not launched yet, is 80-80, obviously much more volatile and relies more on the correlation, which is not 100% the case to be always negative, but we think it's an interesting alternative for people that are long 100% equities and perhaps they want to take some profits, bring that to 80, and take advantage of the anti-bubbles and inflation that could bring something like Igneo. Looking into more detail into the portfolio, I think most of you are familiar with the strategy. Some of you might be seeing it for the first time. And basically, Igneo is a strategy that has three key building blocks: precious metals, treasuries, and options in insurance. The particularity here is we have relatively stable weights, call it 50, 30, 20, and also very important, the insurance bucket only buys options. By just buying premium, it gives you asymmetric risk profile by construction. We can only lose the premium. We have potentially unlimited upside. And those options, we look to buy put options on risk assets, call it bubbles, and call options on anti-bubbles. So it tries to perform that role of defender by construction. We have plenty of candidates to help us build that portfolio across VIX, calls on the VIX, calls on gold, puts on S&P, volatility, correlation, emerging markets, etc. Many pieces that we combine to try to create this diversified portfolio. Here you see the contribution both in absolute and relative terms, and how the option book has always been perhaps a more volatile component that has been responsible for these very big returns, but it's also suffered meaningful drawdowns, even if the risk is always capped to the premium. The rebalancing process by which we bring the weights back to target, and we keep a constant risk profile, it's a double-edged sword because it allows us to take profits on the way up, but it's effectively continuing to buy premium and stay with insurance at the current level. So if you bought S&P puts at 3,000 and the market's gone progressively all the way up to 4,500, those 3,000 puts obviously lose a lot of value and they don't protect you as much. So if you are rolling those strikes up and you're now protected at 4,500, you've been spending a lot of money, you've been pinning yourself to the wall as you climb the mountain, but it's taking time and money. And so the balance here between protection and carry and premium spent is something that we balance carefully, but nevertheless we will always try to be well positioned for what we think could come, and whilst we have these limits, there's flexibility to actually implement them. So you see here that we're currently about 15.3% in premium, which is split throughout time with different maturities and different underlines. Gold or gold related is a meaningful part of the strategy, is almost half. The reason is we see perhaps gold as one of the most distorted markets, and given the current setup and outlook, we think that it has meaningful asymmetry. We've been wrong for the last 15 months. It's been very painful for all of us, and also the insurance against the lower equity markets is been very difficult, because as you buy that, it's been losing value. Rates, dollar have been better behaved. We have positions that I love, including the 30-year option that I think will pay us 40-1 in the event of a major crisis. And the portfolio is, I think, well positioned against multiple dynamics. But again, I think higher gold, lower equities, lower China, higher volatility, and higher treasuries are probably the key drivers that will explain our behavior. This graph shows a little bit more granularity on the payoffs as well, where we try to combine vanilla options, which are great, but often quite expensive, with other ways like exotics or hybrids that look to take advantage of skew or correlation. And to show you some examples, this is just a vanilla gold call. It's great because you risk your premium, you have unlimited upside. The caveat is, you if nothing happens, you're losing time value, but it's a great thing to own. Given the contango and the shape of the volatility curve and the skew, we like and favor structures that allow us to give up some of the upside in the event of a big move. And we do that at the expense of cheapening the option, improving the carry, and also positioning us for a positive carry move in a moderately high price environment. So these are things that we see a lot of value. We look to rebalance when gold has been progressively lower. We've tried to rebalance and accumulate, and but again, it's been one-sided. We have a number of insurance that is now close to at the money, and we are hoping and looking forward to gold stabilizing and performing well for some of this to pay into year end and beyond. The flip side of this is also how we play the S&P. Once again, massive skew on the downside, which is something we like to monetize with this type of payoffs, which allow us to buy insurance at a fraction of the price, because we believe that there is downside, but there's also the risk for higher prices, and therefore this allows us to stay in the game with lower carry by potentially giving up some of the gains in extreme scenarios. This is something that goes well on a full portfolio basis. And some examples, we talked earlier about correlation in China. We've added, I put this trade example in the monthly, a trade where we're betting on gold higher and China lower. And last week we put on a full one-time notional of insurance, where the vanilla gold call was about 7-8%. The call on dollar China, the put on China, basically on the yuan, was about 4%. And by introducing the correlation, the worst of basis, which, as you can see in the graph, theoretically will pay under very extreme scenarios where both events happen, you can actually buy for a fraction of the price, in this case, roughly about 1%. So huge discounts to the vanilla, but I think they fit very much our view that directionally gold higher, China lower, with asymmetry and good good convexity of 10-to-1 or potentially higher. This balance of balancing out, options over long with the premium and the carry and the payoff is something we try to do to our best of our abilities and mandate. There are things we cannot do because of the strategy of the mandate, but generally we have a lot of flexibility to implement these options. And again, we believe that whilst it's been a very, very difficult time, many of these options are now marked almost at zero, and this is going to be a very interesting year end with many of the things we discussed during the call. So quite a detailed update. We covered a tremendous amount of ground. I also have some materials for which I discussed in previous updates, such as the case study for what happened during COVID. Happy to share that if some people are interested from previous calls, and also in terms of AUM, and I want to thank all the institutional clients that are actually topping up. It's greatly appreciated. I'm really sorry, and I wish the numbers were a lot better. And I think those that came in with the momentum of August last year have suffered large drawdowns. Some of you decided to exit, some of you stayed. I just want to insist, this is an incredibly difficult time for defensive strategies, but the fragility of the system and the risks are huge and growing. And I think whatever you do, just be cautious. The risks are again playing out in front of our eyes, and whether you choose Igneo as a goalkeeper or one of the goalkeepers of your team or not, I think and strongly recommend caution and to embrace things like volatility and gold as part of your portfolio construction. I sincerely hope the update has been helpful. If you have questions, please send them through email, and I remain at your disposal for any additional clarification or information you may need. All the best to everybody. Stay healthy and speak soon. Thank you.